Hey everybody, Matt from 90th percentile.ca here. For access to more study notes, practice questions, mock exams, and end of chapter question videos, visit 90th percentile.ca and sign up for your free trial today. Link below in the description. Now that we're at understanding income statements, we're finally getting into the heart of the financial reporting topic, and some of this stuff is definitely possible to be on the exam, so we'll spend our time on it. Really quickly, main two topics are depreciation, and in particular, we're going to discuss different depreciation methods. So like straight line or double declining balance, we'll work through those, figure out, you know, how those methods calculate depreciation. We'll go through some formulas, and overall, we're just looking at the impact on depreciation, which flows through the income statement and impacts net income and taxes. We'll also discuss a couple inventory valuation methods, so like LIFO, last in, first out, FIFO, first in, first out, and weighted average cost. And depending on which inventory valuation method is chosen, not only will this impact the value of assets on the balance sheet in the inventory account, but this will also impact the amount of COGS that flows through to the income statement. Moving on, we're also going to discuss EPS or earnings per share. We'll go over the calculation for simple EPS, which is pretty simple. And then we're also going to discuss diluted EPS, which is an extension of simple EPS. And basically what diluted EPS does is it, calculates the earnings per share, assuming any convertible securities that are in the company's capital structure are converted into common equity, which in result leads to a higher number of shares outstanding. Existing equity holders get diluted, so they don't own as much economic interest in the company as they would otherwise. And we'll calculate diluted EPS, which is something pretty important to look at on, if you're looking at any financial statements in practice, these two will always be disclosed. Analysts typically look at diluted EPS because, you know, especially in the event of an acquisition, like if you're looking at a high growth company that, their exit strategy is to get bought out, in the event of an acquisition, all of their convertible securities would be converted at the time of acquisition. Um, so diluted EPS is definitely something to keep an eye on. We'll go through the treasury stock method, which is just a way to calculate diluted EPS from simple EPS, but there's some additional steps that, can seem complicated at first, but we're going to make sure we take our time and really understand it. So with that, let's just jump right in. Fairplay had the following information related to the sale of its products during 2009, which was the first year of its business. We have revenue, million, returns of goods sold, 100,000, cash collected 800, cost of goods sold 700. Under the accrual basis of accounting, how much net revenue would be reported on the income statement? Well, accrual basis, so we're not worried about cash, and cost of goods sold is, below revenue, so that's not relevant either. The amount that they would report would be the difference between the revenue and, revenue minus returns of goods sold. So a million minus 100,000 is 900,000. Um, a quick note, if it was a cash, if the income statement was on a cash basis, they would report the 800,000, of course, but we're doing accrual basis. So we report, like I said, the net of revenue and returns of goods sold, and the difference between this 900,000 and the actual cash collected would be accounts receivable. Here we're talking about FIFO, or first in, first out, which is a inventory valuation method. Um, we'll go into a bit more detail on it when we get to the understanding balance sheets module. But just as a really quick overview, there's a couple different inventory valuation methods that we can use. One is first in, first out. Another one is last in, first out. Another one is weighted average cost. FIFO looks something like this. Let's say I have a company and I don't know, we sell boxes. And I buy one box January 1st, the second one January 2nd, third one January 3rd, fourth one January 4th. If it's January 5th, let's just say I started the business January 1st, and if it's January 5th and I've sold two boxes, whatever comes in first would go out through my income statement, right? So then we would have cost of goods sold if I sold 2 boxes. The cost that it cost me to acquire these 2 boxes would go out through cost of goods sold on the income statement. And then the cost of these 2 boxes that are remaining would be valued on my balance sheet as part of inventory. And the whole idea behind, the differences in FIFO and LIFO are that in an environment where costs are rising over time, so like if there was a different cost from box 1, box 2, box 3, box 4, then depending on if you do first in, first out or last in, first out, your cost of goods sold and your balance sheet values are going to differ just, depending on which method you choose, right? And depending on which jurisdiction you're in, you can choose to use FIFO or LIFO. It's up to management's discretion. Such as a really quick summary of it. But to get into the question, we have a company in 2009. They began business in October. They purchased 10,000 units of a toy at £10 per unit. So 10,000 times 10, and this was in October. The toy sold well in October. Just this. In anticipation of heavy December sales, the company purchased 5,000 additional units in November. So we have another 5,000 in November at 11 each. And during 2009, they sold 12. So during the whole year, they sold 12,000 units at a price of 15. Under the first in, first out method, what is their cost of goods sold? So we don't really care about this sale price, right? We're just worried about cost of goods sold here. So we sold 12,000, right? I'll bring this down here. We sold 12,000 and we had 15,000. So the first 10,000 that we sell, the cost of goods sold is going to come from this purchase that we made in October. And then the remaining 2,000 that we sold are going to come from this batch that we bought in November. So it would actually be, so the cost of goods sold, so we got to figure out the cost of these 12,000 boxes or toys that we sold. And that would be, so 12,000, or sorry, the first 10,000 were at $10. And then the next 2,000 were at 11. So this is 100K and this is 22K. So the total of this is 122,000, which is our answer. Which inventory valuation method is least likely to be used under IFRS? FIFO, LIFO, or weighted average? Under IFRS, you actually can't use LIFO. It's not permitted. LIFO is only permitted under GAAP, which are accounting standards that typically are used by US firms. So under IFRS, this is kind of what I was saying earlier about it depends what jurisdiction you're in. IFRS, you can't use LIFO. You can use FIFO or weighted average. GAAP, you can use all three. At the beginning of 2009, Glass Manufacturing purchased a new machine for its assembly line at a cost of 6,000 or 600,000, 600K. The machine has an estimated useful life of 10 years and a residual value of 50K. Under using the straight line depreciation method, how much depreciation would Glass take in 2010 for financial reporting purposes? Well, the depreciation is going to be the historical cost of the asset minus the residual value over the useful life, which is 10 years. So we would have 550K over 10, and every year they would charge 55,000 in depreciation. So our answer is A. Really quickly, this residual value, in case you're not familiar with it, this is basically assumed to be the value after 10 years of the asset when the asset has been fully depreciated. The management team has discretion over this, so they can, inflate or deflate depreciation values by changing this. But the asset value will not ever go below this on the balance sheet. And then the useful life is also something that management has just like some discretion over. Usually there's, like some guidelines for like normal assets. Like if you're dealing with like a really common piece of machinery, you can't just, say it'll be depreciated over 200 years. Like some of the people are going to question that. But, you know, management makes some relatively safe assumptions. Safe's not the right word. They make some fair assumptions on the useful life and residual value, and this results in the case of straight line depreciation, the same 55K every year. Um, Notice that we were depreciating this asset in 2010, and it was purchased at the beginning of 2009. So this is actually the second year of the asset's life, and we still have the same 55K depreciation, but the net asset value on the balance sheet would be the 600K. Let's draw this a little bit better. So at the beginning of 2019, the asset will be worth 600K on the balance sheet. At the beginning of, 2019, 2009, at the beginning of 2010, which is the same as the end of 2009, it will be worth 60K minus the 55K, so 545K. And then at the beginning of 2011 or end of 2010, which is where we are effectively at this question, like we're depreciating it for all of 2010, the asset value would be the 545 minus the 50, which is 490, 490K. Now we have the same info from the last question, but we have to calculate depreciation in 2009 under the double declining balance method. So the difference between the double declining and the straight line, the double declining is essentially an accelerated form of depreciation, which you're going to have more depreciation in early years and then less in the later years relative to the straight line method. The way you can calculate the percentage to use, so because basically the formula for double declining depreciation is the net value. So this is like book value less accumulated depreciation. And then you have to multiply this by a depreciation percentage in the year. And this net value is, by the way, at the beginning of the year. So to get this depreciation percentage, what we can do is take the useful life that we had up here from the straight line and essentially go, 1 over 10, take the reciprocal. So using the straight line, we're effectively taking 10% depreciation every year, and that's not accounting for the residual value, because in the double declining method, we don't, like you can see up here, there's no residual value. We'll get to that in a second. But basically, like I said, so straight line is 10% a year, so we're going to multiply that by 2, so we're going to do 20% per year. So to calculate the depreciation in 2009, this is important, right? Because it was purchased at the beginning of 2009, we're depreciated for the year of 2009. So the beginning of period values is 600K, and we multiply that by the 20%, which gets us 120K. So answer is C. Really quickly, you'll notice that, we don't have residual value as part of the double declining balance calculation. You just have to make sure that when you're going through and calculating this depreciation, you check, the net book value after this depreciation, and make sure the net value doesn't go below the assumed residual value. So it's kind of like almost a manual check, just to make sure it doesn't go below. So, going out of the scope of the question a little bit here, but this was the 2009 depreciation. If we were going to look at it for 2010, so the next year, the net book value would be the difference between the 600 and the 120. So we would have 480K, then we multiply that by 20%. The next year of depreciation, we would get 96K, right? So you can see the depreciation decreases year over year. With the double declining balance method, you have the most, the year with the highest depreciation is always the first year because we have the highest net value of the assets. And then towards the remaining years, like if you're in like year 9, 7, 8, 9, probably, kind of just guessing, not actually doing the math, but towards the end of the useful life, this depreciation method, the double declining, um, will probably produce a lower depreciation value versus versus the straight line method. So if you're thinking of it from an accounting perspective, you know, the firm has the option to choose for the most part which depreciation method they could use. So if they were using the double declining method, we have 120K of depreciation in the first year versus what the 55K that we calculated previously. So by using this method, getting the higher depreciation, you're actually going to decrease your net income, which also results in lower taxes in the early years, and then in the later years, the opposite would be true. A company chooses to change an accounting policy. This change requires that, if practical, the company restate its financial statements for all prior periods, current and future periods, or prior periods shown in a report. Answer is C, prior periods shown in a report. Um, if you kind of just go through the list here, if a company's been around for 50 years and they change one accounting policy, it doesn't really make sense for them to go back 50 years and change all their statements. Just doesn't add much value, and it's a lot of work for the company. And investors probably don't care that much. For current and future periods, well, yes, they're I guess their current period report would already be changed. Um, Future periods they can do from there on out, but this initial change has nothing to do with the future periods really. They just have to keep, well, they don't even have to keep the policy the same in the future. They could change it again if they wanted to, but regardless, they're going to have to restate or make the prior period shown in a report comparable to the current period. And typically companies will show, like, if it's a 2022 report, they'll show all their income and all their financial statements for 2022, and then they'll usually have like 1 year prior as well. So they would have to redo it for 2021 in this case. For 2009, Flamingo Products had net income of $1 million. 1 million. At the beginning of the year, there were 1 million shares outstanding, and on July 1st, so exactly halfway through the year, the company issued another 100,000 new shares for $20 per share, and the company paid 200K in dividends to common shareholders. What is their basic EPS? So the dividends aren't relevant. We're looking at earnings per share, so like net income divided by weighted average shares outstanding. So the key here being weighted average, right? So we can see here, we had 1 million shares at the beginning of the year. And then we added 100,000, but this is only for half the year. So we actually multiply this by 0.5, and we end up with a weighted average shares outstanding of 1,050,000. So this net income for the year, the million across the year, is divided by the weighted average shares outstanding. It kind of makes sense because these 100,000 shares didn't get the full million. They were only there for half the time that the million was generated. So that's why we're taking the weighted average. So if we do 1 million divided by 1.05 million, we get 0.95 EPS. And also note that the price at which the shares were issued at aren't relevant. They're just tossing in some more information. The price at which they issued would be reflected in their balance sheet in the equity accounts, as well as the cash that they received. But for EPS, we're just worried about net income over weighted average shares outstanding. Here we get into diluted EPS. Before we actually solve this question, just wanted to mention 3 different types of securities that will result in diluted EPS, or more shares outstanding as opposed to like the, standard or normal amount of shares outstanding. So there's three different types of securities which can be converted into common equity, right? So the whole idea around dilution is that if we have more common shares outstanding, the existing equity holders will own, less of a stake in the business. So the first type of convertible securities that we have are convertible preferred shares, which of course are, a different type of equity, but they can be converted into common equity. And these are dilutive if the dividend paid on these shares divided by the new shares that are issued in the event of conversion are less than the basic earnings per share without dilution. Similarly, convertible debt, which can be converted into common equity, is dilutive if the interest paid on the debt times 1 minus the tax rate, because interest, there's tax savings associated with interest because the interest flows through the income statement. So if interest times 1 minus the tax rate divided by the new shares outstanding in the event of conversion is less than basic EPS, these are dilutive as well. And then finally, for options and warrants, if the current share price is greater than the exercise price on the options and warrants, they will be dilutive as well. We'll dive more into options and warrants in the derivative section, but for now, this is all you need to know. Back to the question, we have a company reporting net income of 12 mil and a weighted average of 2 mil shares outstanding during the year. It's nice that they gave us a weighted average. They paid 800K in preferred dividends, so we're gonna have to keep note of that. 800K in preferred dividends, and had 100,000 options outstanding with an average exercise price of 20 bucks. 100,000 options at $20 each. They can exercise at 20, and the market price over the year for the stock was $25. So the price of the stock currently in the market is greater than the exercise price, so these options are going to be dilutive. And in order to calculate diluted EPS here, this is known as a treasury stock method, where we're going to calculate how many shares are issued upon exercise of these options, and then the company actually gets proceeds from these options, right? Because like the people are actually buying, they're exercising their option to buy the shares at 20 bucks, so the company's going to get 100,000 times the 20. And then the second step in the treasury stock method, and it's an assumption that's just used throughout this method to calculate diluted EPS. The proceeds that the company gets from these options, they're going to use to repurchase shares in the open market at the average price over the year, which will actually reduce the shares outstanding from the initial increase here. So it's like, the shares outstanding is going to increase and then it's going to decrease a little bit by what they're buying back. So we can just get into it. So they are going to exercise 100,000 options at 20 bucks, right? So 100K times 20, and they get 2 million in proceeds. And now they're also going to have an extra 100K shares outstanding because they exercise 100,000 options. And to repurchase shares now, they're going to take this 2 million and divide it by the 25 per share. And we're going to calculate how many shares that they can repurchase in the open market. So 2 million divided by 25 is 80,000 that they're repurchasing. So if we kind of organize this a little bit, we have shares outstanding, which is the denominator in our diluted EPS calc. So the shares outstanding is going to be the 2 mil plus the 100,000 where we exercised. But then we're buying back 80,000 of those in the open market. So the net shares outstanding is 2,020,000. So we have the denominator for our diluted EPS calc. Now for the net income, we're going to take the 12 mil and we have to subtract what we paid to preferred shareholders in the form of dividends. So 12 mil minus 800K minus 0.8 mil is 11,200,000. So now to calculate diluted EPS, we have the numerator and the denominator, and we can bring it over here. So we'll do 11.2 million divided by 2.02 million, and we get 5.54. So that's our answer. When calculating diluted EPS, which of the following securities in the capital structure increases the average number of common shares outstanding without affecting net income available to common shareholders? So converting which of these has no impact on the income statement. So for stock options, we kind of went over that in the last example. When exercising stock options, so we'll do A here, the company gets cash, and they use that cash to, this is inflow, this is outflow, they use that cash to repurchase shares. And this is only reflected on the balance sheet and the cash flow statement. There's no impact on net income. So this is going to be our answer, right? But we can do the rest as well. Convertible debt, if we convert the debt into common equity, we're no longer paying interest on the debt, which is on the balance sheet, right? So converting convertible debt would actually increase net income to common shareholders by interest times 1 minus the tax rate, because there's a tax shield associated with interest paid on debt. And then for C, convertible preferred stock. Well, if we convert this, we're not paying the preferred stock dividends, which is subtracted when calculating net income available to common shareholders. Preferred stock is, like a quasi equity debt instrument. Can kind of be thought of as like half debt, half equity. But the key point of this is that the dividend we're paying on preferred stock is subtracted on the income statement before calculating net income to common shareholders.